Good morning, everyone. It's 8:18 a.m. Pacific Standard Time. The date, 12/27 of 2012. Why are we gathered here today? And I hope that everyone had a great Christmas and a great Happy New Year for 2013. Part of this analysis is based on the analysis that we have given over the last 60 days with the fiscal cliff is that we've been correct about the Thanksgiving rally here off of the bottoms on the chart. Okay, and we were deeply oversold, and in volatility we make that high within the rally and we pull back and we finally do what we call a major 1, 2, 3, 4 day top at resistance. But notice that the highs are a little bit lower, and look at this big red daily distribution bar. This particular trend line on this daily chart is that Reed was on TV. We have no deal at all. Everyone understands what the fiscal cliff is. If you don't, go back and look at other prior videos that we talk about. So far, we have not been wrong. There is no deal. Yes, markets were oversold. Yes, markets have gone up on light volume, but here is the reversal on the S&P that we called for. And in other videos, we said right below 1450 that we could rally up right below it, and that would be the reversal. And how do you confirm it? We've had 1 day, 2 days, 3 days, and this is the fourth actual daily reversal. Yes, for standard technical analysis, you're below the 10 and the 20. Yes, this support level is being breached or violated, meaning that we're below the movement averages. The next support level is going to be at 1398.91 on the S&P. That's going to be the main one. Once again, this green line, I'm going to draw a trend line right above it. That is a 200 simple day moving average right there. So 1390.62 is going to be a very key relevant support level. I will tell you, though, that going into January, and we've already told people what January would look like, and that it would be down. We're already starting that process. We're 4 days into January of 2013. Before it gets here, we already have 4 days of that reversal for January in play. Now, here's the thing. Down here is going to be a half daily bar, and that's going to be 1372.70. That is another major support level. The next one below that, well, it's going to be 1360 on the S&P. Now, we said up here in our live trades, here we're live in the market. This is not after the fact, and all the analysis is before the events and their directional movements take place. We are putting together a very special invitation for 2013. And what that is it's a new subscription model that we feel that you can benefit from if you're going to be involved in the market. And within that special offering, there will be many, many other subcategories and programs that you'll be able to get involved in. And you will be able to have a checklist, and you will be able to check off what you want to learn. And we'll make sure you learn it. But we'll be teaching you in a much different way. It won't be the old day trading models. It will be high frequency models, and it will be everything that is generated between buys and sells and on balance volume. There are many different topics. I don't want to go into those topics, but you'll be able to find it in that special offering. And what you want to do is sign up for that. And this is the kind of analysis that we have, and we have many other ones prior to the S&P. We already said how we would rally up. You get your November and your December Christmas rally, but Congress has been a real drag on your New Year approach and your Christmas. This is not that much of a Thanksgiving and Christmas rally. We get them every year, but within the volatility of the fiscal cliff, Congress has been out every single day. They haven't come to a conclusion. And the blame game is the blame game, but nonetheless, if you're going to be involved in markets, you're going to need the skills to manage your risk. And the risk is when markets go, if you own stocks and stocks are going down, you need to learn how to protect those positions, dollar capital risk management. That will be one of the premier training subjects that you're going to want to learn in calendar 2013. And you're going to want to know how to buy the greatest sectors. I'm just letting people know that we are going a lot lower in the S&P 500. And I can show it to you in our platform that we do have a platform that works on a daily level that is mathematically coded. That's going to be hard for you to interpret, but nonetheless, each one of these lines are $6.50. When we came up here to the very top of this teeny line, that was our resistance, and that was reversal 1. When we started buying the S&P over here on the daily, you will notice that the math was going up. These diamonds, when the diamonds go up here, daily diamonds, and you pull back and you hold support, that's called expansion, then ascending up. When the diamonds go up, things go up. But then look, we started hitting those tops that I talked about. That was the original top. This was the rallies that we've had of late. This was all of your first major reversal up here that we called for at 1475 at the top. And we had that big reversal, but you have volatility. You come down, you come back up, you test it, you come down, and these are directional movements. But then you make the real big lower low here, and this is that November rally, Turkey Day, and Christmas built right up here. And we came right up here mathematically to this half bar, which was 1443.60 right here. And then we've come straight right back down here, and we're at 1409, and each one of these lines are $6.50 to the penny. They don't lie. They do not lie. The math, when it's descending in value, that is a reversal in markets that go down, and you need to have the put side of the market to protect gains or make money. But you need to know that this very bottom over here in our market maker platform, and this is all mathematically, the chart behind me is just a standard chart. So what? I could show this to 10 hedge fund managers and I'm going to get 10 different opinions right here. But this math, this platform, these diamonds, for what they represent, and if you want to come and see them live, you're welcome to. Spend anywhere from 1 to 5 days with us. Once I have an interview with you. Once I have my interview with you, then we will decide what is the most important thing that you need to work on by you telling me. Using the platform is that is that support line, but each line is $6.50. And it tells you right here, and you need to come and join us so you can find out more about this. Because math doesn't lie. TV lies, analysts lie, opinions lie, everything lies, but the math never does lie. And this is a mathematical system. And mathematical systems, there is formats in markets that go negative deltas and positive deltas for the bull and negative deltas for the bear. And when the math changes to go this way, you need to be selling into moves up here, like we said. But we can go a lot lower than this last low, and let me prove it. Over here, when we were putting in the high, we pulled back. You always have upside volatility, then reversal volatility, then upside volatility. But when you can't close above where this math is at the teeny line, then you get the descending value here. You go down, and then you get upside volatility. But look at the diamonds. The diamonds are going down in value. Yes, you're always going to have some upside volatility before you roll over within the broader trend of this original 5.5-year high right here. And the thing about it is, we are in this broader time period. This time period right here was on 9/14 of 2012. That was the daily date right here. And then we dropped all the way down here from that high of 1474.51, and I said 1475. I was that close. Didn't matter. The math changed, and we had a reversal. The math ascended, went up in value, and it tested it, and it rolled over. It came back up, and it tested it again. But look at the diamonds. Look at the red bars. These whole half bars right here, mathematically, you were closing below them. That's where the weakness would come in, and then you made the lower lows. From these lows, you still made the lower low. But you bounce up in volatility, and look at these. So you broke the low right here. Had a little volatility right here. And right here we had 1, 2 teenies at $6.50 a line, and it changes every day, but that's how accurate these lines are. That the value, let us not be in denial, is $6.50 per line. That's how accurate it is. Then the thing about it is, when we're selling off like we are today, we're minus almost a whole delta. So a whole delta today is $6.50. We're 0.96. That's a half a delta movement. Each one of these are half a delta movement in our system. You don't know what the system is. Don't try to figure that out in a video. You'll learn that when you get here, and you'll learn how to trade the markets with it. Or you'll get our alerts with it. So we got a major support level at 1409 on the S&P. And basically, turkey rally, Santa Claus to the top reversal, and a big sell-off today. You can see here in the live video right now that we are down considerably. And we are down on the Dow. Right now we're only down 78 handles. On the Nasdaq, we're only down 18.91, and Nasdaq 100 right here at 17.69. And S&P is only down 10 handles. But that's a fairly decent reversal. What needs to happen, because they can't make the fiscal deal, they need to sell these markets all the way down here, and I'm going to show you. Here's what they need to do, my friends. And because you are our friend, this was 1275 on the S&P. And that was exactly when we had the great bull run in June. We had a big correction from the original highs, but look at these highs we made. That was a great bull run. So when you're getting our alerts, you're going to be getting these bull runs, but you're going to be getting these big bear reversals and then bull runs. And it's going to help you naturally adjust your risk to your portfolios. For those people, for the people that want to be in a school, or they want to buy some kind of service, or they want a training program to learn how to do this, we do have the platform, and you will be trained with the platform when you're in one of our 90-day placements programs versus a weekly program or a 2-week program or a 30-day program. But if you're going to be in the 90-day program, you're going to be having this application. You're going to be trained how to use it. It doesn't lie. Standard technical analysis lags. This platform, when you visit me and we have our conversation and we spend a few days together going through the market live, and you can see for yourself, you'll be quite overwhelmingly feeling extremely pleased, because it doesn't lie. The thing about using this platform this low is going to come into jeopardy in January. By February, we could be right back over here at 1275 on the S&P, exactly where the up move started on 6/5 of 2012, right here. That's the ultimate low from the original calendar 2012. And 2012 is coming to an end. And listen, we're excited about 2012 because when the markets go this way, we get to make money. When the markets go up like that, we get to make money. We get to get the longer, broader movements in bull runs in the S&P like this. But now we have this one reversal, and we tested about half of where that June 5th move occurred. We're right here. That's about half of the whole trend cycle. When you take the low and the high, and we're in the middle of the trend right here, meaning that the bull and the bear right here were neutral. And up here, the bull was in control. And up here, the bull is in control. But when the bull gets below this last low, no, the bear will be in control. Right now, the bull, even though that the markets are pulling back here, and we're right here on the S&P right now, and I showed you that we're selling down, and that Congress doesn't have it right. But here's the general consensus I've always told you, and I have it in the live videos even from 2 months ago, is that they need to teach Congress a lesson for not being able to make decisions. And what does that mean? You sell these markets down where they get on sell, just like they did back in the TARP day when we dropped 700 points. Boy, they came the next day and made a decision about our economy and about the American public's future. What I have to say to people that are involved in the market, whether you're a novice individual or you're the most advanced hedge fund manager that has been not performing in calendar 2012, 86% haven't, and I think 11% have, and the rest of them haven't. So listen, we can help you too. Everyone is welcome here. It doesn't matter what level you are. You could be the very beginner, or you can be one of the most advanced people who need to relearn the markets. Listen, the world changed. The markets have changed significantly. High frequency algorithmic programs are in markets. There's a lot of artificial price movement, but you can take advantage of it. You need to be trained about it. And the people that are training others, you need to come here and get trained by me so that you can train them correctly. So that you're not left behind as you are. The old day trading models lag everything now. They're not like it was. They're outdated. Ours, well, this is a market maker model, and it goes over many calendar days and years and months and days and minutes. It doesn't matter. What matters is where are we at in the broader markets overall using the S&P 500 daily. And why are we going to break this low in January? And every move that Congress comes out with, any upside volatility, this is your, listen, Thanksgiving and Christmas is when stocks should go up, and they should go up through January, February, and March. That's not going to happen this year. It happened last year. It started 2012 that way. But it's not going to happen this year. We told you that 3 months ago. We told you that 2 months ago. We probably even told you that 3 weeks ago. We are always evaluating the market. And we're updating it for our school attendees and people that are involved so that they can go back and review it. Now, you as an individual, outside of that placement, you need to get placed within the SMF different services that we're going to have. And we have so many of them. We know what you need. We know what you struggle with. We know what high frequency programs are. The exchange model, for 30 years, we've been involved in it. We do everything mathematically. It will not mislead you. And you will be able to do it live. And directional price movements, whether they're big bull runs and bear runs, bears go down and bulls go up. And then the overall yearly trends are mathematically adjusted in our longer term systems that I'm not showing you here. What I am showing you, though, is that this low is going to come into play. Because when we get in the earnings season, even though that earnings won't be a complete catastrophe, but growth is going to contract. And that the stimuluses that we currently had are going to come off. And not only that, if they have to do the entitlement cuts. So we have had from 2009, we have had a great bull run. And on this weekly chart that I have here behind me on the S&P, I'm just going to give you, here is the long trend line on the S&P from 2009. That's when we were back in the financial crises. Now listen, if you had a bull economy, expansions last between good ones like 48 to 60 months, and then we always get into a big problem. Shallow recessions happen and this and that. Listen, this particular expansion going into year 2013 from 2009 lows, this is this long diagonal trend line on this weekly chart. We're going to come back here and we're going to break it. And I'm just showing you on the weekly here on a standard chart, not in the MMT platform. But I will tell you that contraction and growth will bring this thing down over a long period of time. And the problem is that a lot of policies are not getting done. What the markets will do is sell it down. And lower growth is going to be lower growth. Food inflation, things where the consumer are not going to participate, is what's going to drive this lower. And that this is a stimulus, monetary stimulus program. They have monetary base. They pump lots of liquidity in the system worldwide. They still are. But guess what happens? When those entitlements and spending cuts and things like that and the other forms of stimuluses, there are many, many, many that are used by Ben Bernanke, the Federal Reserve Chairman. And I can tell you that Happy New Year to you and Happy New Year to all of you, and that we do want to help you. If you will help yourself, you just come and visit us. And listen, There's lots of things you need to learn. We've spent our whole life learning every new change in the market over the last 3 decades. Right now, we've gone to a level that people are not familiar with in the markets as far as your intraday, your dailies, your weeklies and quarterly, monthlies and yearlies is that we have a new high frequency trading component in the exchange model. And the exchange model has changed. What I'm going to tell you is that what drove it higher, once that expansion is no longer expanding, we have to come lower. And that it's not an overnight process. You will have corrections and bounces and volatility. This was calendar 2012 on the weekly, and we're going to be ending 2012. Here's how it started last year. Last year was doom and gloom over here with Europe. But here, we gapped up on the first day and we went straight up. Now, what if I tell you that January, that started right here, that started calendar 2012, we made the highs, you had your corrections, and you made the last highs up here, and you came to this lower high right here. And yes, you still had a rally. You still had your Christmas rally here and your Thanksgiving here in this weekly chart. But let me tell you something. When we start breaking down, we have a long ways to go lower. So the start of January of this year can be quite the opposite. We start down. I've already said that January was going to have a lot of volatility to it in 2013. I said it 3 months ago. I said it 6 months ago. I said that once this rally was over and they couldn't make a deal. Listen, they can't make a deal. Congress. And listen, there's a lot of things that are going to happen. This whole rally from 2009 up to 2013, as we start it, we can start a whole different thing, a whole different process, and markets can really get whacked. Yes, the financials are doing better because of stimuluses. Yes, the housing sector is doing better because of stimuluses. Yes, economic indicators, some of them look better, but are they organic growth that is causing those economic indicators to go higher? Or was it the stimulus that created those indicators to go higher, which the bulls buy into, analysts buy into it? But what is the real deal? Was it really growth or was it stimulus? You got to know how to separate the two in economic expansions, and we're experts in that. Many things outside of just trading is that we have programs that you can get involved in. But why could the S&P come all the way back down here and break this calendar 2012 weekly low, which is about 1278? Where my trend line is at 1278, and if we bust that, we can get all the way back down here to where what we would call a 2012 low. Let's say it's right around whatever it was on that day. My support line is 1257. Now, we already told people you were going to get a 100-point correction from this 1450, that you would come to 1350. You will come here. That will be a 100-point correction in the S&P again. But then you had the same 100 points up. You went from 1350 here to almost right here, 1450, at 100 points up. And you get 100 points down. That's 200 points round trip. This is where what we will tell you is that when I draw this diagonal trend line off this weekly chart and it comes right to here, because that's through this whole correction period, is that in this whole correction period that we called, but then this is the long breakout bull period to the double top reversal one. And so this was a higher reversal than this original one. Now this reversal is going to be lower than this one. And the thing about it is that the S&P is very vulnerable. You will have to sign up on that special alert service. You're going to get alerted at least 3 times a week as to where this market is and how you should balance risk. It will be well worth that service. You'll have to learn more about it. You can spend 1 day with us and we'll explain it to you during the live trading day, and we'll go over why you would want to have that service. But we'll spend a day with you before you have to pay for that, so that you can clearly see what we're talking about before you commit to that. And we'll do that. And we're not wrong on the analysis, and this is the S&P. And let me tell you something. What drove it higher off of the 2009 lows, these 2012 patterns that happened right here mathematically, those are going to be your support levels right over here, because that's where it started. and we would be back to even. And that any more failures or any deals that happen or the fiscal program is, now that everyone's got this great bull run in 2012, they don't want to let that go. I don't blame them. But the reality is that lots of things are going to happen in 2013. And Happy New Year to you. And we have lots of things. We would like to get to know you. We would like to help you. And just be open and honest in what you need. I know what you need. I know what the struggles are. I'm in this tape every single day my whole life. So I already know what most of your comments are going to be from a retail mindset. And that will change it and we'll make sense of it together. But we can only do that together. We can't do that outside of that relationship, meaning that we have to do this together. So, Happy New Year to everyone. This is on the S&P special preview of the calendar year. Just remember where markets started in the calendar year. These were reversals with great bull runs. And the bear has come in here, and there's another bear that's setting up to break these lows over here. If you're long the market, like most people are out of the way because of what the government action is, even if they come out with the deal, it's not going to be good enough. And then we have to deal with the January 2013 earnings that start. And what sectors and indices are going to fare well or not fare well. And which ones are going to be viable for great bull moves again. There's all, even within bears, companies do well. Once they get to where their growth is going to be sustained, then that's when the earnings will change in a correction. And so, you know, we're not saying that things are doom and gloom because they're not. There'll be bright spots in certain areas, but then there'll be a lot of failure areas based on failed policies made by governments. And which government am I really talking about? The U.S. They have to be responsible. And if they're not going to be responsible, they will sell these markets down. And I've already said that. The problem is the market's been extremely resilient through all of these talks, because they're artificially manipulated in a high-frequency buy and sell tape to keep them elevated. That's a different topic. You'll learn about that. There's so many of them. I'm giving you an opportunity to get to know us going into 2013. We have lots of analysis on all of these moves. But why would markets make lower lows? And what is volatility? How do I adjust myself to volatility? Because this is, it went straight up, it was great. Then it reversed, it was great. Then it went straight up and made higher highs in a bull run. So this was a bull run, and it's great. And then when they reverse and they have bear reversals, that's great. And then understanding that the next bear that comes in, that's okay too. Or when the next bull comes in, that's okay. It doesn't matter to us, but we are experts on the yearly movement. This is a calendar 2012 movement on the S&P. I will be doing the other ones individually. They will not be that lengthy. This is a special preview. Once again, the 20-week moving average is about to be violated. Let me tell you another thing. I'm going to blow this part up right here. I'm going to conclude it because I can't go over 30 minutes. You're on the 20-week. The 10-week, the blue line here, is crossing below it. That means that there is weakness within the upside volatility. Why does volatility continue not to go higher? It's because the mathematical reversal that happened over here was much greater in value than the bull, Thanksgiving bull here and the Christmas bull here. So you still have more reversal here than you have in a rally here. So that means that the bear reversal has a mathematical ratio greater than the bull right here. And how does weakness build before they come down and break below these lows over here? They will. Of course, they're going to have support all the way down in the S&P. They always do, always have, and always will. They trade totally different. This index doesn't trade like it used to over the last 30 years that I've been around in it. It trades totally different now because it's artificially propped before the move drops. And that move is coming down. And you better listen. Listen, let's get to know each other. Happy New Year to you. Special preview on the S&P 500. We will have a service that you can get involved in. It'll be a 3-time weekly alert one. But at least you'll know what to do. And then there's training programs involved on how to adjust your risk and what kind of things that you should be looking at within bear and bull structures. Happy New Year. 20-week moving average is about to be violated. The 20-week moving average is 1421 on the S&P. Right now, we are at 1409. We are below that S&P weekly moving average. And the weekly is right now at 1421.79. And once again, I give these forecasts out before they happen. And the reality is you have to get to know us so that you can follow it and you can see the truth. And then you can comment on what we do live here together and where things are going. We want you to be part of success. Take the next step.